Okay. Thank you very much for the organizer inviting me to present now our papers. It's a joint work with the team from BIS, leading by Professor Yongxin and his colleagues. So recently, in the past 5 years, there's a new phenomena in terms of big tech, big company, tech company, like Amazon, like Facebook, like our financials, they provide a credit to the customer, use algorithm-based credit models. So we try to understand what's new about big tech lendings, platform lending, and compared to traditional banking lendings. As Professor Michael Spence just mentioned, it's very hard to get this data down. In the past 2 years, we collaborate with the University of Cambridge, and thanks for the help from Luohan Academia and our financial Alibaba Group, we try to use try to provide some study fact about the big tech lendings and how the rule to change financial mediations. During the next 15 minutes, I want to present, firstly, the study fact about the rising in terms of big tech lendings. Secondly, I would like to explain why some country like China, big tech lending developed so quick, so massive growth. What's underlying reasons? It's because of access credit. It's because we have a very bad segmentation credit market. So first question. Second question, I would like to use a case by Argentina. We use raw data to try to understand big data lendings. Why is the delinquency so low compared to traditional banking lendings? What's underlying reasons? It's because we have more information, more real-time information, and because we have better prediction power in terms of algorithm-based machine learning models. The second question. Finally, if I have time, I would like to talk about what's the benefit. Can big tech lendings can provide a better financial service to the firms, small, medium firms? What's the real effect? Okay? So let me start it. So standard disclaimer apply, but let's look at the cross time change. If you look at the start from 2013, gradually increase in 2017. The red bar represents also fintech like P2P. I hope us to pay attention about the blue bars. The top blue bar is so-called big tech. Amazon, Facebook, our financial, they provide credit to the online customers. By end of 2017, if you look at the right-hand panels in the top, overall big tech lending, based on our calculations, roughly increasing roughly $600 billion US dollars. If you look at the black dot, which is a big tech lending over total share of a stock of a credit. Big tech company like Amazon and Facebook and our financial, they extend massive credit to the clients based on client base, based on technologies. So overall, we want to study these new things in terms of financial mediations, new credit in the market. Okay? Secondly, if you look at who are they, if you compare left-hand panel, we look at the market capitalization by end of 2019. Left panel, we have Amazon, Google, Apple, Facebook, Alibaba, Tencent, Baidu, and eBay. And my right-hand side, look at the famous financial mediation of financial firms. We'll start from JP Morgan, ICBC, Bank of China, Wells Fargo, CCB, HSBC are financials. We can see tech company that provide financial service, the size is much more bigger, like big tech company, much more bigger than the right-hand panel in terms of traditional banking, traditional financial institutions. And so recent people want to argue because access customer base, they have a better technologies. So this is what I want to see the size overall, the big pictures. Thirdly, the funding cost. What's the benefit? So we simply plot the X side, the ratings, rating from triple B to triple A, from left hand side to right hand side. Y side, we talk about the CDS spread, which is the funding cost. Very easy to see this big tech company, they have a large customer network, they have a more recognition trust, access funding is much cheaper. If you look at the red dot, big tech company, the blue dot are traditional banks, okay? So much cheaper in terms of market fundings, okay? So this is benefit in terms of the funding structures. But what's new here, we want to argue. Big tech company, primarily is a tech company rather than financial service, okay? They have extensive network, existing business in the area like e-commerce, social medias, Amazon, social media, Facebook, and Alibaba, Tencent, offer potential to make inroads to the finance. It's number one. They have tech company. They have a big customer base. they have social media, they have technology, they have information. Number two, the activity of big tech in the finance starts with payment. The payment accumulates huge information. In many cases, overlays such as serving on the top existing payment infrastructures. The payment is the key. Number three, increasingly, therefore, they have extended beyond the payment into the provision of credit, insurance, and new saving products. It's a direct, indirect collaboration with the financial institution partners. Okay? They're not only substitution effect, they also have the potential collaborations. It's number one. Number two, those main advantage of big tech company is ability to explore existing network and the massive quantity of data. Big data, more information, and real-time information, which usually traditional bank cannot be covered. Okay? So, such as a social network. And secondly, big tech company should be distinguished from narrow fintech company. As we know, it's very hard to differentiate fintech and big tech. I quote one of a recent research. Think about fintech company is a company digitize money. And the big tech company monetizes data. That's why, as we mentioned at the beginning, it's rising in the past 4 years. Overall, big tech company provide more than $600 billion in terms of credit to the market. It raises lots of questions. We need to know what's going on. So that's why I want to see what's a potential risk and potential challenge. And the bottom line, as an academic researcher, we want to see what's different compared to traditional banking lendings. This overall, so now our research project with the BIS teams. Okay? And the three questions we'll answer, as I mentioned before. Number one, so what's the economic force to explain cross-country variation in terms of big data lending difference? Why China, Latin America, emerging market have a increasing in terms of big tech lendings? Okay? Secondly, we are going to run the cross-country, very simple cross-country analysis to highlight some potential explanations. Number two, once it does, fintech, big tech company, lenders have an information advantage to proceeding the methods, using machine learning algorithms, and particularly related credit scoring. I'm going to show some case, use raw data from Argentina. I want to argue why big tech lendings have a lower delinquency rate. It's because more machine learning models, they become more information. I'm going to show some numbers. Finally, we want to see what's performance for firms who access fintech lending, who firms didn't have access fintech lendings. Okay? Let me start it. Number one, the trends. So in this chart, I just simply plot overall decomposition between red bar represent big tech credit and blue bar represent also fintech credit. More importantly, I want to highlight the dot. Dot means the fintech per capita. For example, if we look at China is the middle. So roughly, China fintech, big tech lending per capita, roughly $372. But if we look at the US in the end, so roughly 126. Okay? So we want to understand why. So one of the potential reasons why China big tech lending per capita is higher than US, cross-sectionally, because of one major reason in terms of we want to highlight the payment systems. So we plot simply US and across countries total payment system over volume over GDP. We look at left hand US roughly 0.6%. In the end, in right-hand panels, the blue bars in China, we are more than 16% in terms of payment service, okay, by big tech companies. So active cross-country typically provide payment system. Big tech company account for 76% of payments in 2006 in China. The payment system is a way to accumulate all the information. That's why I say acquisition which is mission important. More information can help us to do better lendings. Okay? This is one study fact in terms of the underlying reason we want to argue. However, as academia, we want to show some statistics. So also literature. In the literature, I want to highlight why some countries different, and one countries are high and low. We start from demand side. Demand side, because of China and the Latin American and a lot of low-income countries, the offline financial market is less development. A lot of unbankings and credit market is segmented. Most people cannot be served by traditional banking service. For example, credit card coverage in China less than 30%, US more than 90%. So a lot of unmet customers are seeing demand. That's why underlying big tech lendings in China is higher. So recent early work by Luohan and the Luohan academic report, so mentioned about China, also my work about China, why Chinese entrepreneur can get benefit from fintech lendings. Also about to have a paper about India and a few papers about US and Germany. And on the supply side, we have a different story in terms of access data. Some countries have a very strict data privacy regulations, and some countries are not. And also have a technology advantage, whether you use algorithm-based or use relation lending, hard information versus soft information in academia. So research. Also, I want to highlight two other things. Number one, lack of regulations. Government, sometimes some countries' government allow some big tech company to provide credit to the customers. So some countries are not. So regulations among reasons. Thirdly, competitions. Think about a very competitive credit market. And financial service can provide, financial firm can provide better service to the customers. However, some Indian countries, they are very segmented, very concentrated financial market due to financial inclusion of financial repression as reasons. So that's why we want to argue lack of competitions, and maybe it's some underlying reason as well in terms of credit market competition, credit market. Okay. So let me summarize what we found from the cross-country regressions. We want to see if one standard deviation change in terms of a variable, underlying variable, what happened to the increase in terms of big data lending across countries. So we found out if a country of high GDP per capita, one standard increase 1% in terms of big data lendings. In the middle, look at a country of lower the regulation for entry for financial innovations, the big data lending increase more than 1.4%. More importantly, if a country have a more concentrated, less development financial market under bankings, because the offline credit market is so under development, once they allow them to increase, if allow the big tech companies start to lending, they increase more than 1.6%. So that's something we got a lesson for the cross-country analysis. Okay, a country if you have a better, you have a more relaxed regulation schemes, a country have a worse offline finance service, once technology can help, big tech company can provide better credit to the customer who usually cannot be served by traditional banking service. So this is one conclusion we want to draw. Secondly, what's the difference? In contrast to the bank, big tech companies do not have traditional banking branch. They usually cannot be take local deposit. What they do, they use the information, okay? They use the technology to overcome all this kind of information asymmetry. They use very unique data set obtained from the online platform, either through social media or from the e-commerce, so-called digital footprint. New information getting into the credit models. And notably, they use this kind of a new algorithm-based credit model to predict the delinquency default, to provide better credit models. So I'm going to introduce one case from Argentina to show what's new here. So in Argentina, we use one company, private company's data. I want to highlight the blue color and blue line based on traditional credit bureau, the rate every single loans. Usually in Argentina, they have 3 levels: low risk, medium risk, and high risk. And the white side is loss rate, predict loss rate. Okay, so higher, if a low risk group, if you look at the bottom green, so you have a low loss rate. And the high risk group, you have high loss rate. However, if you look at the red dot, start from A to E through every single category. This is internal credit rating system based on machine learning algorithms. You can see the credit rates more precisely and not monotone, start from C to D. It's not linear. So in the end, people say, look, they have internal credit rating systems. What's new here? What's new here? I'm going to show you the last slide in terms of ROC curve. The ROC curve is help us to predict the default. So lower lines, the black lines are random models, 45-degree line. Then in the red dot, a red line is logical model based on credit bureau, traditional FICO models. Okay? Then increase in the top is logical model plus some firm characteristic, the second yellow lines. But in the top, they use internal machine learning algorithms plus new information. They have a much higher, the blue line, much higher in terms of predicting power for default. That's something new we learn from machine learning model to show some ROC curve. Okay? And due to the time, let me just conclude. We have a lot of information about firm result. And we do find out whether we use our financial data, thanks again for the colleagues here, allow us to use our financial data. We see whether you use a BigTech credit, what happened to firm performance. We do find out annual growth rate of a number of offline products increase once access the BigTech credit. Okay, let me take again, thank you very much for inviting me to present this report. If you are interested, you can download from BIS website. Thank you.